Bank of England policymakers have plenty to ponder as wage growth remains robust. Welcome to Market Insight. I'm Ramzan Karmali. Well, nominal average weekly earnings, excluding bonuses, grew by 6% in the 3 months to the end of April compared with the same period a year earlier. Additionally, the unemployment rate rose to 4.4% between January and March, the highest reading since September 2021. So what does this all mean for rate setters at the central bank? Well, to help answer that and more, I'm joined by Russ Mould, Investment Director at AJ Bell. Russ, thanks so much for joining us. Well, let's start with UK labour market data, and the monetary policy meeting is just over a week away now. Is there any chance there'll be a rate cut from the Bank of England at this meeting, or is August still the most likely?
Yeah, I think there's only about a 10% chance being put on a cut at this meeting on June the 20th. And I think the wage growth number may have probably sealed that deal with that 6% figure, because that's what's feeding into services inflation, which is proving much stickier than goods price inflation in the UK economy. So even though inflation is now relatively cool at 2.3%, it's still above target, and services inflation is running well above that. And Governor Andrew Bailey has spoken many times about wanting to avoid the sort of price, wage spiral that we saw in the dark days of the 1970s. Now, we're nowhere near that yet, but it's one of the reasons why the Bank of England won't want to be seen to be moving too early on rates, even if it probably would like to move to cut government borrowing costs, consumers' borrowing costs, and give the economy a lift. Because let's face it, GDP growth still isn't anything special, even if the UK is crawling out of recession.
Now, we heard from President Lagarde yesterday, and she talked about a possible pause in the rate easing cycle by the ECB. Should we believe that the ECB's cut last week will be an isolated one for some time then?
One and done would be highly unusual. But again, I think the ECB has got similar issues to come think about as the Bank of England. On one side, it wants to stimulate the economy. It wants to generate growth. On the other, it doesn't want to move too quickly and risk a rebound in inflation, and also see the euro weaken, because the Federal Reserve is still staying pat. So you don't want the spread or the gap between European rates and US rates to move too wide, just as it would say as it could if the UK moved very quickly, because your currency might go down, and that means imported inflation. So very much all part of a complicated thought process. It's not just one number that they're looking at, but a whole range of them. So one and done would be unusual, but they're clearly going to have to tread very, very carefully.
Well, let's stick with central banks now. And obviously the main event this week is in America and the Federal Reserve. What are you hoping to hear tomorrow?
I think what markets are looking to hear for, again, is some guidance on when that first long-awaited cut will be. Again, the Fed has got exactly the same calculations to think about as the Europeans and the British. You've got politics right in the middle with big election results and trying not to do anything that's seen as politically favourable to one side or the other. You're thinking about inflation, you're thinking about growth, you're thinking about debt, and you're thinking about currencies. The Fed is seen as a certainty to stand pat here in June the 13th. If the first rate cut there is seen maybe September, October, but nothing expected this week.
Now, turning to some corporate news now, and the rescue plan for Atos has been decided on. A David Layani-led bid beat out an offer from Daniel Kretinsky, but the shares continue to fall today. In fact, I think they're over 80% down on the year. So the proposed restructuring still isn't good news for shareholders. So we shouldn't be too surprised by these downward moves, should we?
No, I mean, I guess it's good news in that the company will continue to function, to exist. There will be a very big chunk of its debt turned into equity and wiped out. There'll be a fresh injection of equity, a restructuring of existing debt. So that is good news, and it will give the company some needed breathing space. Though I do remember when these shares traded at 150 euros during the tech bubble in 2000, and now they're down to about one. So that tells you the difficulty the company's been in. But there is light at the end of the tunnel. But yes, the result of all of this is it's massively dilutive for existing shareholders. So the company keeps going, but you can have a much smaller stake than you did previously. Whether you want to get involved in the politics of whether a French solution is better than one backed by a Czech billionaire, I will leave that to the politicians. But it should be no great surprise to anybody who's a student of French corporate culture and corporate history that a French solution has indeed been the preferred option.
Well, let's turn to some positive news now in the corporate world. And Raspberry Pi's IPO looks to have got off to a very positive start. Why is it important that a fairly small IPO in the grand scheme of things is a success?
Yeah, I mean, the UK has only seen 6 or 7 IPOs this year. Its overall share of global initial public activity is down to multi-year lows. So from London's perspective, any deal that goes well is going to be a welcome relief, particularly as other companies have continued to drift off to other exchanges, be they Sydney or New York, for example. So to have a technology stock come to market, have its shares priced at the top of the range, have those shares then go up by a third on day one of trading is going to be seen as a positive. However, just like pets aren't only for Christmas, IPOs aren't only for one day, and this is a long process. So day one is great, but what you're really looking forward to is the share price developing and the shareholder base developing over weeks, months, years. And sometimes an IPO where the share price goes up like the rocket and then comes down like the stick isn't necessarily that healthy either. So I think what you're looking for over time is balancing the needs of the seller to raise capital, the needs of the buyers who want to get it as cheaply as possible, and then the aftermarket. So what you're really looking for is a good aftermarket over time. That will be the ultimate sign of success, but this is a positive first step for a London market that's taken a lot of criticism in the past year or two for not having enough tech and not having enough new deals.
Russ Mould from AJ Bell, as always, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.